Arizona. Mortgage Loan Originator Bond. What is a mortgage loan originator bond? A mortgage loan originator bond, also known as a surety bond, is a type of financial guarantee required by the Arizona Department of Financial Institutions for individuals or companies engaged in mortgage lending activities within the state. This bond acts as a form of protection for the state and consumers against unlawful or unethical practices by mortgage loan originators. Why is it necessary? The primary purpose of the MLO bond is to ensure that mortgage loan originators adhere to state laws and regulations governing their profession. It serves as a safeguard for consumers, providing them with recourse in case they suffer financial losses due to the actions of a licensed MLO. By requiring mortgage loan originators to obtain a bond, the state aims to promote transparency, integrity, and accountability within the mortgage industry. It helps weed out unscrupulous individuals or entities that may engage in fraudulent activities or fail to fulfill their obligations to borrowers. How does it work? Obtaining a mortgage loan originator bond involves a contractual agreement between three parties: the principal, the MLO, the obligee, the state of Arizona, and the surety company, the entity issuing the bond. Here's how it works. Application. The MLO applies for a bond through a surety company authorized to issue bonds in Arizona. The surety evaluates the MLO's financial standing, creditworthiness, and business reputation before deciding whether to issue the bond. Bond issuance. If approved, the surety issues the bond to the MLO. The bond typically specifies the coverage amount, which in Arizona is set at $200,000. This means that the bond provides financial protection up to $200,000 in the event of a valid claim. Bond term. The bond is usually valid for a specified period, often 1 year, after which it must be renewed to remain in compliance with state regulations. Compliance and claims. Throughout the bond term, the MLO is required to comply with all applicable laws and regulations. If the MLO violates any terms of the bond or engages in misconduct, a consumer or the state can file a claim against the bond to seek financial compensation for damages. Resolution. Upon receiving a valid claim, the surety investigates the matter to determine its legitimacy. If the claim is found to be justified, the surety may provide compensation to the claimant, up to the bond's coverage limit. The MLO is then responsible for reimbursing the surety for any amounts paid out, including legal costs and fees. To know more, please visit swiftbonds.com.